Hi, hello friends. Welcome everyone to Intrazon, India's largest retail intraday traders online conference. I am Ashok Devanampriya, the CEO of Traders Gurukul and Stratazon, and also the host for your today's program. It's a great pleasure and honor to invite every one of you to the third edition of Intraday webinar series Intrazon. I'm sure by the end of this program, you will have extensive knowledge on intraday trading, which can help you to make better trading decisions. Before we kick off the program, I would like to appreciate my media partner, Money Control Pro, the largest financial portal in India with millions of daily readership on their website. They helped us to reach quite a larger audience in a short span of time. Let's also thank and appreciate our title sponsor Espresso from the family of Sher Khan, one of the leading stockbrokers in India with millions of investors as their customers. The speaker for today is my good friend Indrazith Shantharaj from Bangalore. He is going to empower us today with a special topic, Open Your Mind to Use Why in Intraday Trading. He's a full-time intraday trader and author of few best-selling books in the Indian markets. He trades using both discretionary and algo trading models, a former IT professional with close to 12 years of experience in the industry. Apart from trading, he spends his free time on travel and adventure. And let's take us through the adventurous journey of Indrajit in the financial markets. My friend Indrajit, on behalf of Traders Gurukul, Money Control Pro, and Espresso, I extend my warm welcome into our program as a speaker. Go ahead, my buddy. The stage is yours.
Thank you, Ashok. Thanks for the wonderful opportunity. I would like to thank you, Gurukul and Money Control Pro and Espresso team for this wonderful opportunity, Ashok. So this is a small introduction about me. I think Ashok has given wonderful introduction about me, so it is not really necessary. Over to you, Ashok.
Thank you. So friends, the title sponsor of Intrazon is our good friends, Espresso, the Share company, who are committed to help traders succeed. The beauty of their arrangement is that they don't charge you for loss-making trades. Okay, it will only charge you on one side of the trade and do not charge you for a loss-making trade. Okay, look forward for more updates on Espresso. Over to you, Indrajit.
Thank you, Ashok. So today's agenda, a session well planned is off done already. So the first topic will be what is open interest. Next, difference between open interest and volume. Next, how to interpret open interest with futures. Next, how to interpret open interest with options. And then how to decode smart money plan using open interest. Next, at the end, we will learn how to club open interest with technical analysis. So disclaimer, I will be showing different slides from different open interest tools, which I use it in my intraday trading every day. Please note, I don't have any business association or personal relationship with them. I'm just showing because it helps retail community. And all the ideas, opinions expressed are for informational and educational purpose only, and it should not be considered for our recommendation to invest and trade in the market. So please conduct your own study as well. So let's start from the basic. How many of you think, friends, intraday trading is risky? And how many of you think, we can make some profits through intraday trading? So you can answer in your own mind. Even in the trading community, many traders say intraday trading is risky and hence they advise to do only investments or positional trading. Is it really the case or scenario? So let's explore. Now, let's say you wanted to travel from Delhi to Agra. The distance between Delhi and Agra is 250 kilometers. Please note it is through Yamuna Express Highway. Now you have three options. Car A, the driver in car A drives at 50 km per hour speed. Hence, he takes 5 hours to reach Agra. The second option is car B. The driver in car B drives at 80 km per hour speed and he will take 3.1 hours approximately to reach Agra. Now, one more option, car C. The driver from car C drives at 100 km per hour speed, hence he take 2.5 hours to reach Agra. Now, which car you choose, friends? Car A, car B, or car C? I will give you 10 seconds time. Think about it. Okay, I guess you might have made some decision. Definitely, I'm confident that most of the people have selected car C, right? And some people might have opted for car B and some people have might have opted for car A. Now, if you give the same choice to me, I will opt for car C. Why? Because he will reach Agra in 2.5 hours itself. He will cut down the journey duration by 50% as compared to car A. But if you ask one question, who carries more risk? Car A, car B, or car C? Definitely, I do agree that car C carries more risk compared to car B and car A. But that doesn't mean car A and car B are accident proof, right? Definitely, there is also some element of risk with car A and car B. But if you opt for car C, we can take certain precautions like opting for a good driver or opting for a car bag which has good airbag, starting your journey after 10 a.m. because in Delhi and Agra, fog and mist will be there in the early morning. If you start after 10 o'clock, the risk will be little less. So by taking certain precautions, we can minimize the accident risk by selecting car C, right? By doing this, car C will provide another 50% of duration to explore Agra. So this is even intraday trading is also similar to like this. So as compared to investments or positional trading, it offers a wonderful platform to make good profits at a lesser time. But definitely because of this feature, it carries certain risk. But we can minimize or mitigate these risks by taking certain precautions like only 2 or 3 trades in a day, closing our trading terminal after taking 2 failed trades or 3 trades in a day, or risking only 1% or 2% per trade. So by taking all these precautions, we can cut down or we can mitigate these risks. So that is my point on intraday trading. Because what is the point of becoming a rich person at the age of 70 or 80? There is no use, right? So that is the reason I always prefer for intraday trading. Now, today's topic, what is open interest? So this is a wonderful topic. I have explored from almost 1 year. Open interest is the number of outstanding or pending contracts, including short and long position held by market participants at the end of the day. For example, if you take open interest at 11 o'clock, it indicates the open interest of all the parties, including both short and long trades at 11 o'clock. Basically, open interest gives a good indication about both market activity and market liquidity and the level of participation in a particular market, which I'm going to explain later in the later slides. And one more point is, high open interest indicates increased interest in the market, either upside or long downside. So now we should use open interest to confirm the market trends and up to some extent to understand the magnitude, but we should use either price action or indicator to take an entry or to take an exit. And also please note, open interest is only applicable to F&O category and open interest is not applicable to equity category. So in equity category, we have only volume, but in F&O space, we get open interest information. Now moving on. Many people will ask, what is the difference between open interest and volume? So please note, open interest is just a number of pending contracts or open contract at any point of time, and it measures both market activity and liquidity. Whereas volume is the total number of contracts traded at any given period. It means it measures only market activity and it doesn't measure the overall pending liquidity. So now, just open interest give you an idea about how liquid market is, whereas volume can give you how active the market is. So moving on, I know it might be a little confusing at the beginning, but I will take a simple example to illustrate open interest in a better way. Now assume there is a company XYZ which is already listed in the in the exchange. Now they are pitching in F&O category. Let's say XYZ company from tomorrow, they are participating in F&O category. So on the first day before market open interest is always zero because it's the first day, right? Now let's say Ram is a person who thinks XYZ will go up in the long run. So he will buy one lot of XYZ futures. And similarly, Sham thinks XYZ futures will go down. So he will sell one lot of futures. Very simple. Ram will buy one lot of XYZ futures. Sham will sell one lot of futures. So basically what it indicates is open interest changes one. Ram is a new player. Sham is also a new player. He took long one lot. He took short trade one lot. So open interest change is one. Okay, this is one. And total Y at the end of the first day is also one. So I hope this is very clear on the first day because it is very easy and straightforward. Now we will go to the second day. On the second day, John is a new player. John also thinks XYZ will go in the long run. So he will buy three lot of futures. But Tom thinks XYZ will go down in the long run. So he will sell three lot of XYZ futures. Please note, before the open of second day, these guys were carrying position, right? One long trade, one short trade. So open interest is already one before second day market open. Now, after the second day market activity, open interest changes three because he is buying three lot, he is selling three lot. Both are new players. So open interest changes three, but total open interest becomes four because this is three, this is one. So total open interest is four. I hope second day is also clear. Now we will make little complicated. We'll go to the third day. Please note, before the open of third day market open, these guys were carrying the positions, right? They are carrying, they have not closed the trade. So this is one open interest, this is three. So total four, right? So this is third day before market open. Now third day, Tom. So Tom, please note, already carrying three short position, right? He will come, he will buy one lot, which means he will reduce his short quantity by one lot. Ram was also an old player. Can you see Ram was carrying one long trade, right? He closes his position, which means Ram was an existing participant. He closes his position and he gets out of XYZ future. Tom is also an existing participant. He reduces his short position, which means open interest change is -1 because Ram was an existing participant. He closed his long trade, which means he's transferred his long position to this guy, Tom. So open interest change is -1. So total open interest becomes 3 now. It's only 3. Okay. I hope third day is very clear. Now we will go to one step further. So this is fourth day before market open. Everything remains same. See, three open interest because John was carrying three long futures. Tom and Sham collectively carrying three short futures. So total open interest remains three. So now fourth day, if you go here, Stan is a new player. Okay, he was not there earlier, so he's a new player. He thinks XYZ futures will go up. So he will buy three lot. John, if you note, John was an existing player, right? Already existing player. He closes his position. He transfers all his three lots to a new party. Okay, which means John is also out of equation now. So which means open interest change is zero because John was an existing player. He he transferred all his position to Sam. So open interest change is zero and total open interest remains same. So this is fourth day after market activity. So this is how we can calculate open interest and open interest change. If you notice very clearly, this indicates the liquidity. Okay, liquidity increases, decreases, but this is not the case with volume. So these are the interesting aspects about open interest. Whenever a buyer seller initiate a new position, the OI count will increase by 1. This is the most important thing. And when both of them closes their position, open interest count will be decreased by 1. So this is also most important. And next, this is where many people get confused. When a buyer or seller passes their existing position to a new person, the OI count remains same. But volume, if you take volume, it considered as a market activity, it increases in this case. For example, if you take here, John was an existing player, right? San was a new player. So John transfers all his position to San. So he's an existing player, new player. So he's transferred as it is all the position to this guy. So open interest remains zero. Open interest change remains zero. So total open interest remains same. But if you take volume, it will be added. So that is the beauty of open interest. So fourth point is the same thing. Compared to open interest, volume count will be added every time, irrespective of old or new participation. This is the most important part. If you take the same example for OI and volume, this is how it looks. After the first day, total OI remains 1, volume remains 1. After second day, total OI remains 4, volume remains 4. But if you go to the third day, total OI is only 3, whereas volume is 5. And after fourth day, total Y is 3, volume is 8, which means in many cases there is a possibility that volume can give you false impression. It's just a market activity. It will not give a clear picture about market liquidity, friends. This is the most important aspect. If you look at OI, it gives market liquidity. Here, volume can give only market activity, and it will not give anything about market liquidity. That is the beauty of open interest. Now, see, even after explaining, sometimes many people will get confused. So I will take one simple example. Let's say in my family, there are 100 siblings. Let's say we have 100 siblings. First one, for example, me, brother one, B1, I will buy one lot. B2 will sell one lot. So now open interest is 1, right? Now, after second day, I will transfer my position to B3. So, which means only B2 and B3 are carrying position now. So, open interest remains 1.